Hear about our company. We are a royalty and streaming company. As I mentioned, my name is Brett Heath. I am the president and CEO. Fairly new company. We've been just over 2 years now since inception. And we've got a very unique approach, which I'll go through here in a minute. But, first I'd just like to kind of touch on the landscape here. This is an investor conference, and most people come to these conferences to make money. Now, as an investor in this sector, you're normally pulled into one of these four buckets. And if you've held a basket of these companies over the last 2 years, you're probably down 20, 30, 40%. In fact, the GDX and the GDXJ since inception, since we started, is down between 30 and 40%. Now, this is no way to make money. There are a number of reasons why, but from exploration companies with very, very low probabilities of success, all the way to the major mining companies, which have a very bad track record of market timing, whether it's buying back hedges at $1,900 gold or writing off through the previous bull market $53 billion in 2015. I like to put that in perspective for investors that the major mining companies in 2015 wrote off 2.5 times the entire market cap of all the mining issuers on the TSX Venture. Just capital destruction. So as an investor, how do you make money in the mining business? Well, it's very, very simple. You invest in royalties or royalty companies. And what we do as royalty companies is we own non-dilutive interests in what we want to build as a portfolio across a number of different counterparties in a number of different jurisdictions. And what does that give you as the investor? It gives you the optionality to participate in a way where you can maintain your exposure in each single asset through that royalty company. If you own a 1% royalty on an exploration property and they make a discovery, they're going to raise more money to drill, they're going to raise more money for studies, they're going to raise more money just to see if it's economic. If it is economic, then they're going to raise more money to develop it and probably need to raise more because they didn't raise enough in the first place. By the time your equity position is by the time that asset's in production, your equity position is likely negligible. Where the royalty company, after we make that first investment, you as the investor of the royalty company have exposure all the way through without any additional capital required by these royalty companies. And what that allows royalty companies to do is have exposure to huge portfolios. In just 2 years, we've got 22 assets. The top 3 royalty companies have well over 100, most of them well over 200 assets. Think about the time, the capital, the money that goes into just pushing one project forward. It's impossible for mining companies to have this kind of wide exposure yet in a way that we really can maintain all that optionality for investors. So the royalty model, there's the traditional model, which is how most of the multi-billion-dollar companies that are in this business were created, which was very simple. To summarize, it's basically they write a check and they say we get a percentage of that production, whether it's a royalty or stream. Now, this model has been so great over the years and has produced a number of multi-billion-dollar companies that it's actually become quite competitive. So as a small company, a new company, we had to find a unique way to break into this market, to get better returns, to be able to compete. And that is the third-party royalty model. And what this means is we focus on consolidating all of the existing royalties. So the royalties that were discovered by the projects that were discovered by the prospector and then optioned off with the royalty retained, the royalties that ended up on the major mining company's balance sheet, in the ownership of a private equity fund through a new investment. All of these royalties have, or all of these holders have one thing in common, and that's they're not getting the true value of the assets that they're holding. And the reason is because royalties are worth a separate amount held individually as a private company as opposed to in a public company with a portfolio of assets. And through this process and through this third-party model, what we're able to do is we're able to leverage our equity as a main part of our consideration, because a lot of the royalty holders don't necessarily want to sell these royalties. They think there's a lot more optionality there. They think there's a lot more value in these assets. So by offering them as consideration, a material part or a stake in Metalla, it allows us to quickly scale this business. And it also provides a number of benefits, not just for these holders, but also for Metalla. Perfect example of this is our latest transaction, which is the acquisition of the Santa Gertrudis royalty. This is a 2% royalty on a property that's being developed by Agnico Eagle Mines, one of the top operators in the world, in our opinion. Now, as a small company, we couldn't go to Agnico Eagle or any of the other major mining companies and say, here's $5, $10, $15 million. It would make no material impact. Yet Agnico bought this project after 2 years of diligence. They wrote an $80 million US check, and as part of the consideration, the company that sold them the property retained a 2% royalty. These are the types of assets that we target to lever ourselves into much stronger counterparties, much more well-known assets where we can move on to the next transaction and build this portfolio. So this is a quick summary of what we've done so far. So 2 years, 9 transactions. We've acquired 22 royalties and streams. And you'll see that every single time we bring in a royalty that's held in any one of these structures into our public company, you see this revaluation event that occurs. On top of this, like I said, it allows us to lever into much stronger and much more developed assets, and it gives us production. We'll generate 6 to 7 million in Canadian dollars this year in operating cash flow. We've got a development portfolio that'll generate another 5 to 10 million over the next 5-6 years. We pay a monthly dividend that is an annual yield of 2.5%, and all this translates back to more value for the shareholders, which is why you see this outperformance and why I think you'll continue to see this outperformance. Again, everything that we do at Metalla is to eventually drive home these premiums that these companies, these royalty companies, trade at. Being diversified is a big portion of that. And you'll see again, in just 2 years, we've been able to pick up a number of assets, not only with great counterparties, but in great jurisdictions. We've got portfolio of production. Like I said, we've got development assets. Most of our cash flow right now comes from one of the largest lead, zinc, silver mines in Australia, and we get 100% of that silver. We've got development assets from Pan American, Goldcorp, Osisko. These are some of the top operators in the world. Again, this is what's going to drive the value and the premium for our shareholders and for our investors going forward. We have a portfolio of early stage assets. Providing optionality to investors is a really important thing. In fact, a lot of the major companies, the bigger royalty and streaming companies, some of their most valuable assets were investments of $2 million or less. You get that by holding a portfolio of exploration royalties, again, not having to put up that additional capital as deposits are discovered and put into production. We've got a great team. One great takeaway from looking at royalty companies versus mining companies, some of the highest revenue to employee metrics of almost any industry. The top 3 companies generate on average between 18 and 24 million in revenue per employee. Metalla alone will generate 6 to 7 million this year. And if we stopped doing transactions today, our shareholders would likely receive dividends for the next 20 years. That's capital back to investors, back to shareholders, which rarely happens in this business. So why invest now? One of the bigger opportunities with Metalla is the entry point. Because most of these companies were formed via spin out of a major, they demanded much higher premiums out of the gate. We created this company from scratch, and we've gone from 0 to 70 million in the first 2 years. I think we'll likely be going from 70 to hopefully 500 in the next 2 years as we quickly scale up this company and into more and more valuable assets as we move up the growth curve here. And that's Metalla. Thank you all for coming to listen to the presentation. Thank you.